kind of going forward with inflation, because it's a big, big topic. I feel like until 2 weeks ago, people have forgotten about it again until all of a sudden. But we know rates are really low. We know rates are zero bound, let's call it, and the risk premium or the risk-free rate is what it is. And it's one argument to discuss what expected return should be. But ignoring that for a second and just getting into the inflation discussion, there's different ways to measure inflation. There's different arguments about ways to measure inflation. It seems like the market might be waking up to, hey, maybe there might be some inflation, even though I know you've been arguing that and telling people, hey, this can happen. Like, anyway, maybe talk a little bit about what we're seeing right now when it comes to inflation risk, or the market's pricing that in even.
Yeah, it's pretty peculiar to me because the rates market is almost uniformly thinking the pandemic is going to be deflationary. And I guess being a contrarian investor, I think owning inflation expectations is very cheaply priced because you have, 99% of the world thinking the outcome is known. And I think the one thing I've learned over the course of my career is when everybody thinks something is going to happen, usually it doesn't happen. A good example, like just think about December 2018. The US rates market had priced in 3 hikes in 2019, right? Kind of universally, everybody was expecting the Fed to hike 3 times in 2019. And reality was they cut 3 times in 2019. So I think it just goes to prove that you really don't have any crystal ball. Nobody can predict what financial markets are going to do or what policymakers are going to do, but you can look at what the probability distribution is priced in. And right now we are at extreme levels, in my opinion, of thinking that the pandemic is going to be deflationary, and therefore it is priced appropriately in the rates market. And you can see that with the level of the US yield curve. If you think about what the yield curve is, it's just the difference between 2 interest rates at different points in time. I think the best way I describe it is if, Mark, if you went to, or your clients went to a bank and they opened a CD with any bank and they said, all right, how much yield will I get for a 6-month CD or a 3-month CD? Okay, well, that's not very much. How about a 10-year CD? Right now, you get paid less than 0.5 percentage point to lock up your money for a decade. And that's because there are very little inflation expectations in the future. So I think the yield curve is really a measure of what investors think will happen in the future.